Okay. And we are going to jump into well, we've already jumped into chapter 3. We're going to jump back into chapter 3, and we are going to finish chapter 3. I think we should have plenty of time to get through the rest of the chapter 3 discussion tonight. Um, we just to remember what's in chapter 3, we're looking at assets, and we had looked at current assets, right? And we are continuing on with that discussion of current assets. And this time we are going to go ahead and jump into inventory. We actually started inventory last time, talking about the items that should be included, free on board shipping point, free on board destination. We also talked about the specific cost that should be included, shipping cost or part of the cost of inventory, freight in, freight out is a selling and administrative expense, a selling expense, right? We talked a little bit about that. And then we talked about inventory is typically carried at the lower of cost or market. However, there are times where we can carry inventory at above cost. When we talked about precious metals and whatnot, you can carry that inventory above cost. And then we talked about times where you can carry inventory at cost, even if the market is below. And those were sort of on that next page. Remember, we made that 3 times exceptions to lower cost or market rule. You can carry them above cost. If it's precious metals, you can carry them at cost, even if their cost is, even if their market is lower than the cost, if the ultimate product is not affected, or if you have a sales firm contract to sell it at an amount at cost or above cost, then you can carry it at cost. So that was sort of where we stopped, as I recall. And then we were going to start to get into how to account for inventory at the lower of cost or market, or the lower of cost or net realizable value. Now, when we carry inventory at the lower of cost or market, that is a very specific situation where we are carrying our inventory at LIFO, using last in, first out. And we're going to get into the different cost flow assumptions here in a little while. US GAAP is the only thing that allows LIFO. IFRS does not. We're going to talk a little bit about some of the differences between US GAAP and IFRS. My prediction for the exam is that they're not going to hit as much on IFRS. And if you're taking the exam July 1st or later, there will be no IFRS. If you're taking it before, pay a little bit of attention to some of the differences that you see in the multiple choice questions and stuff, but I'm not spending as much time with that in your practice exams, your multiple choice questions and whatnot. I'm not spending as much time with that because it is an area that is being de-emphasized and going to be off the exam entirely in July. Okay, so for US GAAP, where you're allowed to use LIFO, you carry the inventory at the lower of cost or market. So let's start with that. Okay, now they tell us that when we look at market value means the replacement cost. Unfortunately, it's not that simple for IFRS method, US GAAP method, if you're using LIFO. It is not quite that simple because you have to look at that market value against that potential replacement cost. And that market value is going to be the middle of 3 values. It's either going to be the replacement cost, or the market ceiling, or the market floor. So you'll have to evaluate your replacement cost. And if it is over the ceiling, you should use the ceiling. If it's below the floor, you should use the floor. But if it is not over the ceiling and not below the floor, you can use the middle amount, the replacement cost. Now, the hardest thing here is just remembering, how do I calculate market ceiling? How do I calculate market floor? Market ceiling is going to be the net selling price less cost to complete and sell. And we call that net realizable value. Okay, so you'll have to consider delivery costs. They say sometimes cost to dispose of. That's if you have to pay some delivery costs or something associated with that. That will come off of your net selling price in calculating your market ceiling. Once you have the ceiling, you can calculate the floor. The floor is the net realizable value, or the ceiling, minus normal profit. Okay, so that sounds harder than it is, guys. I want you to flashcard the definition of ceiling and floor. And then I also want you to flashcard that our market in the lower cost or market discussion is going to be the middle amount between the replacement cost, the market ceiling, and the market floor. Now you go over here and you just look at this example of lower cost or market. Again, this is LIFO only. I'm going to show you the easier method that you use if you're using some other inventory method, such as FIFO, let's say. Okay, but let's just look here for LIFO. LIFO is only used by US GAAP. And for LIFO, notice they give me the cost. Let's look at this first item. They give me the cost. Okay, I have to see if the market has fallen below that cost, because if it has, under lower of cost or market, I'd have to bring it down to that lower cost. So they give me replacement cost. Now, when they give me replacement cost, I know already that I'm going to have to write this inventory down, because what the replacement cost is showing that it is below the original cost, what it cost me to acquire, produce this inventory, whatever. Okay, but I don't know if I should use replacement cost, because I have to evaluate replacement cost now, and I have to see, is it over the ceiling or is it below the floor? Thus that flashcard, because if I don't know how to calculate ceiling and floor, I'm not going to be able to answer this question. So they would give me the selling price, tell me cost of completion, for example, delivery cost, that sort of thing, is $1. So my ceiling here is going to equal 24. Okay, 25 minus 1, that doesn't look like 4, very good though, is going to be 24. Then I have to subtract the normal profit, and that normal profit is going to give me the floor. 24 minus 6 is 18. Now I look at my replacement cost, and what? It's not over the ceiling, right? 24 is the ceiling. It's not below the floor, so I will do what? I will use the 19. I'm going to write it in down here under the solution. It's in the middle, so I will use the 19 as my cost here for this. Okay, so again, you had to evaluate your market by what? By basically saying that I was not over the ceiling, I was not below the floor. Okay, okay, good. Question. Want to do another one?
Yes.
Let's do another one. Okay. All right, good. Let's do number 2. So for number 2 now, the cost is 26. I have to see if my market is below the cost. I have to write it down to that lower market using the lower cost or market requirement. They tell me replacement cost is 20. Okay, but I have to evaluate replacement cost, make sure it's not over the ceiling, make sure it's not below the floor. When I look at my cost to complete off my selling price, I get a ceiling of what? 28.
28.
Good. I subtract the $7 in normal profit. That gives me a floor of 21. Uh-oh. Now I have gone with my replacement cost below the floor. So I'm going to report that inventory at what? At 21, because the what? Replacement cost is below the floor, right? And so on. Question? Can't go over the ceiling, can't go over the floor. The hard part is knowing how to calculate the ceiling and the floor.
Can't go below the floor, right?
Correct what I say. Can't go over the floor. Can't go over the ceiling. Can't go below the floor. Sounds like some sort of weird, song. Can't go over the ceiling. Can't go below the floor. Right? For our replacement costs. If it goes what? If it goes over the ceiling, use the ceiling. If it goes below the floor, use the floor. If it's not over the ceiling and it's not below the floor, use the replacement cost, right? And then of course, if the market is, is higher, then you leave it at cost. If the market is lower than the cost, then you're going to write that inventory down, right? Lower cost or market. Okay. Now that's how it works for LIFO. And LIFO is only used by US GAAP. So that's what you need to do when you're using LIFO. Okay. Now, what we do for every other type of inventory method, we simply look at the lower of cost or the net realizable value. So it's used for FIFO, all other inventory methods except LIFO. And net realizable value is what? Computed the same way we compute the ceiling, which the ceiling is net realizable value under the lower cost or market method. So now you don't have to calculate the floor and compare it to replacement costs, etc. You just look at the net realizable value and you compare that to the cost. And if the net realizable value is lower, you write it down to the lower net realizable value. If the cost is lower, you just leave it at that lower cost. Okay, so let's just look at the next page over. Okay. And, let me look at one thing just to kind of emphasize the comparison to cost part. Let's look at this journal entry down here that they're telling me. So in this example,
all right, is everybody back?
what would you do?
All right.
Let's say we were doing this example.
I think our highest.
Huh? You talking to me? Okay. I don't think they're talking to me. Okay, hopefully they'll figure it out to mute in a second. But what happens right here? This is saying 19, right? And the cost of that inventory is 2050. So how much below the cost are we? 2050, and I should be using 19 for that, right? Because the replacement cost was not over the ceiling, it was not below the floor. That's a difference of what, 50 cents? How much difference is that? $1.50?
$1.50.
$1.50. That's a difference of $1.50 that I want to write that inventory down to the lower market. I've determined that the market is 19 using my lower cost or market method for LIFO purposes anyway. And so I'm going to debit loss due to inventory of $1.50, credit the inventory $1.50. I'm assuming, I don't know if that was on a per unit basis or what, but if they only had one unit, then they would write it down like that, right? Is that the write down?
So you put the difference.
Yeah, look, this inventory, if it's being carried at cost, the inventory was being carried at 2050. That was the cost, right? And I bought the inventory. I debited inventory 2050. I credited cash or accounts payable, whatever, right? When I bought that inventory, that's its cost, right? And I looked and I did this analysis. I decided 19 is the appropriate market by evaluating the 19 against the ceiling and the floor. If I want it to be 15, then I have to credit this what? I have to credit this $1.50 Now the balance is 19, isn't it? Isn't that what I wanted? Lower cost or market, I've got it at the lower market. If it turned out that the market was higher, I don't do anything. I don't have to do at that point. Okay. All right, now that's lower cost or market method. With lower cost or net realizable value, all I have to do is calculate net realizable value, compare the cost to net realizable value, and if the net realizable value is lower than the cost, I write it down. So here, they're telling me that what? The selling price is 30, cost to complete. So the net realizable value here is what, 27? That inventory is being carried at 28.50, so I would write it down. I don't have to go through the market ceiling, the market floor. I simply calculate the net realizable value, compare the cost to net realizable value. This inventory is sitting here at what, 28.50. I have to write it down. I have to write it down to $27. So I have to credit $1.50, debit the loss, right? So it's just one calculation, much easier for methods other than LIFO. LIFO is the only one that they make me do that ceiling and floor jazz. Okay. Question? Okay, good. Now I want to go back. Flashcard that. What we do for all other inventory methods other than LIFO, it's the lower of cost or net realizable value. Oh, I'm sorry, guys, right here, not there, right here. For all other inventory methods other than LIFO, it's the lower of cost or net realizable value. Very simple. That's the easier one, right? Okay, and then I want to come back to this page. Okay, because if we have those losses, okay, they tell us that when you have to write down a loss under US GAAP, it's usually reflected in the cost of goods sold. So instead of crediting inventory and debiting loss, I would debit cost of goods sold instead of debiting loss. I still credit inventory to write it down, but the debit goes to cost of goods sold instead of going to loss on inventory, which is a specific line item on the financial statement. So I would say that $1.50, we would just lump it into cost of goods sold. But then US GAAP tells us unless the amount is material, in which case the loss should be shown in a separate line item, then you would have to debit loss on the inventory item. Okay, so go ahead and flashcard that. And then reversals, US GAAP does not allow us to reverse a write down. Once it's down, it stays down. Whereas IFRS does allow you to reverse that write down, but you are capped at the original amount. So you can't write it up above its original cost, but you can write back up losses in the valuation of the inventory if you had to write it down to a lower market value, and then you can come up to a higher market value in a later period. That's fine, but you're capped at the original cost. So you can reverse write downs under IFRS. US GAAP, you cannot. Question. Hardest part of this, trust me, guys. When I took the exam, I could not answer one of these questions. Not when I took the exam. By the time I took them, I was pretty good at them when I was studying. I could not answer one of these questions. And then I realized my problem was I didn't know the definition of ceiling and floor. That was the only thing I was struggling with, because once you know definition of ceiling floor, you take that replacement cost. If it's over the ceiling, then you're going to use the ceiling. If it's below the floor, you use the floor. If it's not over the ceiling, not below the floor, you use the middle amount, you use the replacement cost. Always use the middle amount. Okay. All right, good. Let's go ahead then. And let's just take a look at the next page now, where we're going to start to get in to comparison of periodic and perpetual. Now, I guess the examiners are going to continue to ask periodic. I would say that these days, most companies will not use periodic because periodic says, look, I'm not going to ever count my inventory until the end of the reporting period. That's when I'm going to count my inventory to see how much is left. And that will allow me to calculate my cost of goods sold. Well, these days, because they have scanners and now they have things that, automatically order inventory and all these different things as we get into more and more into big data. I would imagine most companies use perpetual, but the examiners still like to ask periodic. Okay, so we do need to understand how both of these work, periodic versus perpetual. So I want you to flashcard right here how you calculate cost of goods sold using periodic. And, if they ask you a question about periodic directly, this is useful. Sometimes, though, it could be useful just to help you calculate cost of goods sold, where maybe they've told you something about overstatements or understatements in beginning inventory or ending inventory or something. Okay, so it could be useful that way. So I want you to flashcard this. You need to know this very well. I always say, know it like a Catholic priest, right? What? Beginning inventory plus purchases give us goods available for sale minus ending inventory equals cost of goods sold. You need to be able to rattle off what constitutes the cost of goods sold in this. You can't mess around with this. So make sure you've got this flashcarded, okay? Now, with a perpetual system, and with the, before I move on to that, the ending inventory, again, it's contemplated that you don't know what your ending inventory is until you get to the end of the year and literally sit there and count. Now, there are obvious disadvantages to that. I tell my students sometimes that it could be cost of goods, what? Cost of goods sold or stoled and stoled. If you don't sit there and count your inventory to the end of the year, people are going to be walking out the door with your inventory and you won't know it. So it's probably a good idea, even if you don't have a perpetual system, to count your inventory more frequently than once per year as a good internal control procedure. Okay. But here we are now, we've got this periodic method. Now we're going to look at this perpetual method. And with the perpetual method, we will have to calculate our inventory and our cost of goods sold after each purchase and then after each sale of our inventory. So we calculate our inventory balances when we make a purchase of inventory. It's going to increase our inventory balance, obviously. And then when we sell items, we'll account for that inventory by decreasing our inventory. Okay. Okay, good. Now you come over and let's go ahead and take a look and see how this is going to work in this example. And they're going to give us comparisons of the two methods. And I'm going to start down here at example 4 because I just find it a little difficult to start with 3 because they sell the inventory before they have it. And that doesn't work for me. I like to have the inventory and then I'm going to sell it. Okay. And we're going to look at both. We're going to look at perpetual and we're going to look at periodic, and we're going to look at perpetual first. So perpetual says every time you buy inventory, you have to debit the inventory account, credit cash, accounts payable, whatever they credited cashiers, they paid for that. Then what? Then when I sell the inventory under perpetual, okay, when I sell the inventory, of course, I'm going to sell the inventory for more than my cost because I want to make a gross profit on that. So we'd have 140,000. We'd have 100,000. So we didn't sell all the inventory. We only sold 100,000 of it. So we'd have a gross profit of 40,000. I would debit cost of goods sold. I would credit the inventory because under perpetual, I've got to keep track of every inventory transaction as I purchase it, as I sell it, right? Okay. Then what? Well, what I'm going to do is I'm just going to tee up inventory. And I'm just going to see that the balance in the inventory after that first sale is what? 200,000, right? So that's the beauty advantage, if you will, of the perpetual method. And then I know at any point in time what my inventory balance is. And I could almost do an eyeball check, say, hey, my records are showing I've got $200,000 worth of inventory and everything's gone. What happened? Right? And so then I would start to know that there's something wrong and things are being stolen, et cetera, right? Okay, so you get better control, obviously, with the perpetual method. Now, let's say, though, we were using the periodic method, okay? And under the periodic method, instead of debiting inventory when I purchase the inventory, now I'm going to do what? Now I'm going to debit purchases for 300,000. And I'm not going to count the inventory, during the year. I'm not going to count for the inventory during the year. But at the end of the year, I'm going to count the inventory. And that's how I'm going to calculate my cost of goods sold. So even though here they show you when you make the sale, you debit cash, you credit the sales, but I am going to have to adjust by year end to say, well, what's my inventory balances now? So the two methods give you the same answer. It's different roads to the same outcome. So I have this purchases here, okay? And what I want to do is record my inventory. So what happens? So now I'm going to go ahead and I'm going to say, well, beginning inventory. And I'm going to assume the beginning inventory was 0. My purchases are 300,000. This is the Catholic priest formula. My goods available for sale are what?
300.
300,000. My ending inventory, and I would have to what? I would actually have to count, wouldn't I? Okay, but since we're in a classroom here, or you're at your house, I'm at my house, however we want to look at that, I'm not going to be able to count. That says count. I'm not going to be able to count the ending inventory, but I'm going to peek up at perpetual, and the count should reveal that my physical inventory is actually 200,000. So I would use this approach to figure out my cost of goods sold, therefore is what? 100,000. And you're saying, well, John, I know the cost of goods sold 100,000 was right there. Yeah, if I had perpetual records, but if I don't, and I'm using the periodic, that's how I would calculate my cost of goods sold. And then I would be able to make what entry? Well, I go ahead now, because remember, I never debited the inventory when I bought inventory. So I'll debit inventory for 200,000. I'll debit what? Cost of goods sold for 100,000, right? Calculated it there. I counted my inventory 200,000, and I can credit purchases now for the full 300,000 because I don't need that purchases account anymore. It is a vehicle that helps me calculate the cost of goods sold under the periodic method. I don't need it for any financial reporting purposes. On my income statement, I'm just going to report sales minus cost of goods sold, gives me gross profit of 40,000 in this example. Okay. Question? Okay, good. Now you come over and we've kind of started the discussion of perpetual versus periodic, but we are going to look at that more in the context of cost flow assumptions. The cost flow assumptions that we're going to cover are going to be FIFO, LIFO, weighted average, moving average, and then we're going to get into some sort of boutique type methods, really, where we start talking about gross profit and dollar value LIFO. Okay, now they've kind of mislabeled this a little bit because specific identification is not a cost flow assumption. Specific identification says, hey, I'm going to go ahead under specific identification and account for each inventory item uniquely to that item. To use specific identification, you must have a perpetual system. Things like high-end products, like say luxury cars, okay, they're going to use a specific identification method. You know, I always laugh when you go and you want to look at a new car and you start asking about different things and they start, oh, well, we don't know if we have that. And they start acting like, you know, they're going to find a unicorn for you. You know, meanwhile, it's like, I'm thinking to myself, get on your specific identification inventory method and look on your computer to see if you have the things that I want. You don't need to sit there and wonder. They do that so that then they can act like they did you a favor by finding something special. Meanwhile, they have all those things in their inventory. And it's just a matter of punching up some buttons to find the color, the size, the number of, you know, horsepower and all that. It's all listed in specific identification system. Okay. All right, good. Now, the cost flow assumptions, yes, FIFO, LIFO, and so on. Okay. So under FIFO, the first cost inventoried or the first cost transferred to cost of goods sold. So let's just go ahead and I'm going to co-op some of this space down here. I think you know all this, but it's not a bad idea for us to just sort of take a second to just visualize what's going on with FIFO. Okay, so what happens? Let's say you go to Safeway. Okay, so this is going to be Safeway over here. You ever go to Safeway? Okay, and this is you. And I'm going to have you wear, I guess you got to wear a mask now, okay, when you go to Safeway. So that's you wearing a mask at Safeway. And you've got your little shopping cart and you go back to the milk fridge, right? Okay. And when you get there, they're saying, you know, $5 for milk. That's the price that they're charging you for the milk. Okay, $5. And then you look and you start looking at the dates on the milk. Okay, and so let's say they've got some milk here and it costs them $4.25. And let's say they bought that milk on April 1st. Okay. And then they've got some milks over here. This is their cost, guys. They're charging you what? $5. Their cost, it costs Safeway $4.25 to get those milks. Okay. And then there's some in here that it costs them what? $4.50. And let's say they got those on April 15th. Okay. And then they've got some back here in the back of the fridge. Did it cost them $4.75? And we'll say they're going to get those on $4.30 on April 30th. And of course, here's the Safeway truck. Does Safeway have a trucking system? Look out if they get behind you. They will run you over. Safeway's got a huge distribution system. So what happens? They go ahead and they deliver those, right? And then you come along and which ones do you put in your cart? I know everybody likes to say, Well, I'm going to reach to the back and get the 430 ones. And my answer is, it doesn't matter. These cost flow assumptions may or may not relate to the actual flow of goods. Okay. GAAP says the company can choose the cost flow assumption they want, regardless of how their inventory actually moves. Okay. So you can go ahead and jump in the Safeway truck and take the deliveries from May away from the guy. Doesn't matter. We will assume under cost flow assumption that you're going to take these 425 ones. So that means Safeway's cost of goods sold is 425 because they assume the first items that got put in inventory April 1st are the items that they're going to sell first, and their what? Ending inventory is going to be what? Is going to be these 475 ones that they bought on April 30th. First in, first out. Okay. So let's go back up and let's make some flashcards out of some of the things with that little visual that they start telling us about LIFO, about FIFO. And we say that ending inventory includes the most recently incurred cost. Thus, ending inventory approximates replacement cost. If the Safeway truck backed up and crushed all those milks that were sitting there at the back of the freezer, how much would it cost them to replace those? $475. So when you do your little lower cost or market, there's probably not going to be much difference under the FIFO method because the items that you're including in ending inventory are pretty much at the current replacement cost. Okay. So flashcard that yellow, flashcard it as an advantage of FIFO. That's an advantage of FIFO. Okay. Now they also tell us that ending inventory and cost of goods sold are the same whether you use the periodic or the perpetual method. We're going to actually have a numeric example here in a minute, but we're going to see that regardless of perpetual or periodic, you will still have the same answer for your cost of goods sold. You'll have the same answer for your ending inventory, regardless of which of the two methods you use. Okay. All right, good. Now, let's go ahead and flashcard this passkey. And in periods of rising prices, the FIFO method will result in the highest ending inventory. You can see that right there. The lowest cost of goods sold. You can see that there. We're in a period of rising prices. And the highest net income. Okay, flashcard all that. And then this part, current costs are not matched with current revenues. Flashcard that as a disadvantage of FIFO. That's a disadvantage of FIFO. Okay, what's going on here? Well, if we have $5 as our sales price, right? And we're calling out a cost of goods sold of $425 if we're using FIFO. Now our gross profit is what? 75 cents. If we were somehow compelled to what? Report the true cost of this inventory now at 475, we would have a gross profit of what? Of 25 cents. So our net income would be down and we would be reporting what? A better number for our gross profit here, right? So the FIFO method has that disadvantage, is that it's matching current sales price with what? Older cost numbers for my inventory. Okay. Okay, good. So let's go ahead then, now that we got our flashcards set up, and let's take a look at this. And, you know, inventory has long been an area that the examiners like to focus on, and it's something that could come up in a task-based simulation where they could give you a set of facts, and then they like to ask you calculate cost of goods sold and ending inventory under FIFO, LIFO, weighted average. Okay, so these examples that we have coming up are very, very useful to you to help you in the event that you were to get a task-based simulation that asked you something like that. Okay, and what's interesting about this question is not only did they ask you to get cost of goods sold and get ending inventory using FIFO, they also asked for the periodic and perpetual method. So this is a pretty comprehensive example here, right? Okay, so let's just look at the fact pattern. And we have this company in its first year of operation, purchased all of its inventory in 3 batches. Batch 1 for 4,000 at $425 per unit. Batch 2 for 2,000 units at $450 per unit, and batch 3, 3,000 units at $475 per unit. They sold what? They sold 4,000 units. 3,000 units were sold after the first purchase, and then 1,000 units after the second purchase. Okay. Now you come over and we're going to calculate cost of goods sold and ending inventory using periodic, using perpetual. So let's go ahead and let's look at periodic. Okay. And let's just make sure we are kind of clear on what happened here. So they bought what? 9,000 units?
Yep.
And they sold what? 4,000?
Yep.
So they got 5,000 left? Right? Okay, just sort of looking at that. Okay, and what happens? First in, first out, since that was the first batch, we assume those are what? All gone, they're all sold. So my 5,000 units that are left in my ending inventory, I'm going to value what? Those 2,000 at 450, right? They told us they paid 450 for those. And these 3,000 units at what? At the 475. And so I go ahead and I extend that out, and I've got my ending inventory part of the answer. And then my what? My cost of goods sold is going to be, they had no beginning inventory, but here's all my purchases. Goods available for sale are 40,250 minus ending inventory using my Catholic priest formula gives me the cost of goods sold. So I'm able to answer the question that way. Okay. Now, if it's perpetual, we're going to keep track of our cost of goods sold and our inventory as we go. So you buy those 4,000 units at 425, you got 17,000 in there. And then you're going to go ahead and do what? Sell 3,000. You value those at 425, which is the only cost in my system anyway. So that's not a challenge at all. I haven't bought anything else yet at this point. And so I would go ahead and credit my inventory for 1275, debit my cost of goods sold. Then I buy some more inventory items at 450, that second batch. Remember, they told me that the first sale happened after the first batch. That second sale doesn't happen until after that second batch, right? So I got to get those into the inventory. So when I debit inventory, that brings my balance up to 13,250. And then when I sell, I still have what? 1,000 of that first batch, because there was 4,000 of those. I sold 3,000. I still have 1,000 of those. And so first in, first out, I cost them out at 4,250. I credit my inventory. I debit my cost of goods sold. I got my cost of goods sold. I bring in that batch 3 at 475. I didn't sell any of those, and I have my ending inventory. Now notice, guys, the point that we made earlier, the what? Inventory and cost of goods sold amounts don't change from the perpetual to the periodic, because we assume that everything was sold at the first in, first out. And so there's no situation here where we're going to have to consider amounts being sold other than the order that they came in. Okay. Now, if you get a task-based simulation in which they're asking you, hey, calculate cost of goods sold, calculate ending inventory under these different cost flow assumptions, perpetual and periodic, you can start to get overwhelmed and tangled up in calculations like that. So if you get something like that, remember, you don't have to work the simulation in the exact order they tell you to, okay? You could do what? You could jump to the one that you think is the easiest in that task-based simulation. Of course, I'm assuming they're all in the same testlet, which they're not going to mix that and put it in another testlet. Assuming they're all in that same testlet, you could do what? You could sit there and work them in any order you want. So let's say you got that question. I would recommend you start with weighted average, because weighted average is the easier of the methods that we use. So what happens? Notice they take everything they bought. There's no beginning inventory. They take everything they bought, 40,250. They divide that by the total number of units, 9,000, and they get a weighted average cost per unit of 4.4722222222. I do that 2222 because I get students, John, I tried it and I can't get their answer. And it's because they rounded here. Meanwhile, there's enough twos after that last 2 that you see here to mess up your answer to where it would make you feel funny. So don't, if you redo this calculation, notice that you get a long irrational number in there, 4.47222222, whatever. Then once I get that weighted average cost per unit, for my cost of goods sold, since they sold 4,000 units, I multiply that by 4,000. For my ending inventory, there were what? 5,000 units left, right? So I just go ahead and multiply that by 5,000. I get my ending inventory. That's easier, isn't it? Because you're not having to say, when did they go out? Perpetual versus periodic. Much more straightforward, okay? And we're going to do LIFO in a minute, but let's go ahead and do something called moving average method, okay? And what moving average does is it's going to calculate a new average, okay? New moving average every time I have a purchase of inventory items. So any more items are added in, then I'm going to recalculate my average. You see this a lot now when they calculate the average, the average for COVID cases, and they call it the daily moving average. So as cases get added, they add in, they calculate a new average. That's a moving average. Each time we add more in, we're going to calculate a new average. That's called moving average. Okay, so what happens? We sit here and we have these 4,000 that we bought, and obviously that means that I have a moving average of 425. When I have that first sale, remember they told me that the first sale happened after the first batch, I use the 425. So I sold these 1,000, okay, and then, excuse me, these 3,000. I sold these 3,000, I have 1,000 left. And then I buy what? Then I buy 2,000 more. Well, I added now inventory in, so I have to calculate a new moving average. So I'm adding cost of what? I'm adding cost of 9,000. So the 4,250 plus the 9,000 going to give me this 13,250. The 2,000 plus the 1,000 gives me now what? 3,000 items, I take the what? I take that 4,000 plus the 9,000 is the 13,250. I divide it by the 3,000. That gives me a new moving average because I've added items in, right? Then what? Then when I have that next sale, and remember from the fact pattern, then they sold 1,000. I take that out at cost at what? 4,416, this new moving average cost. And so now 1,000 times 4,417 means that my cost of goods sold here is going to be this 4,417. Then what? Then I go ahead and I bring in 3,000 more units. So now there's my 5,000, right, that I had in ending inventory. I bring those in. They came in at 14,250. So the 833 plus this 14,250 divided by 5,000 means that there is now a new moving average of what? 4,6,166. And I would go ahead and my next sale would go out at that moving average. For my cost of goods sold, it's the two amounts I calculated there. And my ending inventory is sitting here, and it's 2308. Okay. Notice, guys, I must use perpetual system to calculate my inventory using moving average, because I'm sitting here and I'm having to calculate a new moving average every time I purchase inventory. So I'm having to calculate my inventory each time I purchase new inventory. Obviously, that's called the perpetual method, which we've been saying. Question? Okay, good. Come over. And let's go ahead and look at last in, first out. Okay, now last in, first out, as we've said, is not permitted under IFRS. And under last in, first out, the first cost transfer to cost of goods sold are the last items to be added to my inventory. So let's go ahead down here, guys, and I'm gonna kind of draw a little picture down here, I guess. I don't want to draw my picture. I'll draw it kind of up here. Okay, so this is a rock pile. That's a rock pile. Okay, and what happens? Well, the rock company that sells, like, decorative rocks and stuff that you're gonna have in your backyard, whatever, they have the rock company. When the rock guy comes, he does what? He delivers the rocks on top of the pile. Okay, the rock seller that sells the rocks to the rock company doesn't sit there and say, hey, where do you want this delivery? Oh, wait, let us knock everything down because we're going to use first in, first out, right? They just dump on top. Then what happens? Then say your landscaper, who's going to put some decorative rock in your backyard or something, comes, and when they take that inventory, they do what? They take it off the top of the pile, right? You're not going to dig down to the bottom and take them out of the bottom, okay? Now, the rock guy is selling you the rocks for $5. His cost was $4.25 for those that came in on 4/1, $4.50 for those that came in at 4/15, and $4.75 for the ones that came in at 4/30. Now again, Safeway could do it this way if they want to. It doesn't matter the actual flow of goods. I'm just trying to get a visualization here for us, right? Our cost of goods sold here is what? $4.75. Our ending inventory is $4.25, isn't it? Okay. So now let's go ahead and let's take a look at some of the things that we'll put on flashcards about LIFO. Okay. And so let's go ahead and let's take a look. Ending inventory will include the oldest cost. Thus, the ending balance in inventory will typically not approximate replacement costs. Flashcard that as a disadvantage. Don't write all over it like I did. Flashcard that as a disadvantage of LIFO. That's a disadvantage of LIFO because what happens? When we prepare our balance sheet, we're saying that we have inventory that has a cost of $425. Meanwhile, it's really going to cost us what? $450 to replace that. Okay, so that's a disadvantage of LIFO. Okay. LIFO does not typically relate to the actual flow of goods. Most companies are probably going in a FIFO direction. I mean, I came up with an example that's a true LIFO, but for the most part, you know, most companies are going to sell you their stuff FIFO method because Safeway doesn't want to get stuck with rotten milk. But they could use what? They could use the LIFO method, even though their goods are actually going out FIFO, right? Okay. Let's go ahead and flashcard this. If LIFO is used for tax purposes, it must also be used in the GAAP financial statements. Thus, the reason US GAAP could not follow suit with IFRS and get rid of LIFO, because companies don't want to lose LIFO as a method for tax purposes. Why? Well, if you take a look here, if we were to calculate our gross profit now using the LIFO method in this little example, $5 sales price minus $475 now is our cost of goods sold. So our gross profit is what? Our gross profit is 25 cents. So we have a lower gross profit, thus a lower net income. And companies want to keep that lower net income for tax purposes so they don't have to pay as much tax. So companies really, that's one of the main reasons that they got up in the face of Congress and said, don't let FASB push us over to IFRS, because they were worried that if they lost it for financial reporting purposes, they won't be able to use it for tax purposes. If they can't use it for tax purposes, higher net income, right? It would be 75 cents would be the gross profit, higher net income, more tax. And companies don't like to pay tax. And companies that would really lose out are companies like oil companies and stuff. And last time I checked, I think the oil companies have a pretty good lobby. And so what happens, that was probably more than anything what blew IFRS out of the water for US GAAP reporting, for US reporting purposes, because they didn't like the idea of not using LIFO for financial reporting purposes, because if that was the case, they couldn't use it for tax purposes and they didn't want to pay more tax. Okay. Now, taking a look, the use of LIFO method generally better matches expenses against revenue because it matches current costs with current revenue. Okay, well, I like that. Let's flashcard that as an advantage. That's an advantage of LIFO. Okay. Okay, good. Now, if sales exceed production or purchases for a given period, LIFO will result in a distortion of net income because old inventory will be matched against current revenue. So LIFO is susceptible to income manipulation. Flashcard, big disadvantage. That's a big problem with LIFO. Thus, I think the reason that IFRS decided to get rid of it, because what's happening? Now you're putting temptation in front of the company. If I'm a company and I'm looking at that gross profit and I say, I'm going to look like a hero over here. I'm going to show them how to increase their gross profit. So I tell them, hold back purchases for a while. Well, if that's the case, as people come and buy the inventory, eventually I'm going to be down here to the bottom of the pile. And now I'm going to do what? Now I'm going to sit here and I'm going to count for that inventory at 425. And now I show a nice bump in gross profit here. All of a sudden I've tripled my gross profit. I'm a genius. Look at that. Just by holding back purchases. I didn't have to change inventory methods, nothing. All I had to do was hold back purchases production for a while, and now I show a bigger net income. Well, that could be harmful to the investing public because they're looking, saying, wow, company's showing some signs of life. They're moving back up. Meanwhile, they're on the edge of what? Having to purchase a bunch of new inventory items. And maybe by then, those things are up to $5 a piece. And you're going to have to start raising prices and so on and so forth. And all kinds of problems start potentially affecting that company. So that's why IFRS finally looked at it and said, no, we're just not going to even allow you to use LIFO anymore. US GAAP kept it because the tax issue. Okay. Now you come over and our LIFO method is going to result in the highest cost of goods sold. I erased it now, but those 475 ones going out, the lowest ending inventory, the ones down there at the bottom, 425, and the lowest net income, because our cost of goods sold goes up, our gross profit goes down, our gross profit goes down, our net income goes down. Okay, now keep these flashcards that I'm telling you about with the FIFO and the LIFO stuff, and keep them in your BEC pile after you take the FAR exam, because BEC does make you write essay, and they love this kind of stuff for an essay question. What are the advantages, disadvantages of FIFO, LIFO? I've given you some cards on that. Keep it for your FAR exam, but when you're done with FAR, pull them out of FAR and put them in your BEC study pile. Okay. Question? Okay, good. With that, then, if there's no question, let's go ahead and let's take a look at our LIFO example. Same fact pattern, but now it's LIFO. Now, the member had, let's just review a little bit. They had the 9,000 units. They sold what? Sold 4,000. So they ended up with what? 5,000. This is units, right? They ended up with 5,000 units in their ending inventory. Just to quickly remember what we had here. Okay. That's supposed to be a V, ending inventory. Okay, good. Now what happens? They sold 4,000, right? But under last in, first out, looking at the periodic method first, we have what? We have 4,000 of these. I mean, not 4,000, but all 3,000 of these are gone. They sold all of those. They needed to what? Sell another 1,000 to bring them up to the 4,000 that are sold. And that means that left are 1,000. There's 1,000 left times 450 means that we have what? We have 4,500 left in ending inventory of that second batch, those 450 ones, because there's only 1,000 of those left to make up 4,000 sold. We sold all 3,000 of the third batch. We sold 1,000 of the second batch. And so now we have 1,000 left of that second batch, and all 4,000 of that first batch are assumed to still be here under the LIFO method. And so we go ahead and we extend that out. That gives us the 17,000, the 4,500 for batch 2, the 17,000 for batch 1, gives me 21.5 as my ending inventory. My cost of goods sold, same goods available for sale, minus that ending inventory gives me cost of goods sold of 18,750. Now, I know it's kind of easy to go into a little bit of a coma here, so come back to me, because this is where we see how there will be a difference between periodic and perpetual under LIFO cost flow assumption. So what happens here? Well, you bring in these 4,000 units at 425, right? And you got the 17,000, your inventory. Then what? Then when you sell, and remember the problem said that 3,000 were sold immediately after you bought that first batch, before you bought the second batch, right? Well, I don't have any other cost. All I have is 425 in my accounting system at that point. And perpetual method says you must debit cost of goods sold and credit inventory after each sale. And so I have no choice but to use that 425 under the perpetual method. And so I'm going to go ahead and credit my inventory, debit my cost of goods sold for that 12,750 because I have to use the 425 amount. Then I buy another batch at 450, and now I have a more recent cost, a more recent set of items that I'm costing at 450, and under last in first out, I will assume that those units go before these go next. And so when I take that, I take the 1,000 times the 450, I credit my inventory 4,500, debit my cost of goods sold 4,500, and then I bring in those last ones. And notice I do get different answer, right? For my cost of goods sold and my ending inventory, because what? Under the periodic, I sat there and I did what? I just assumed that they sold all 3,000 of those 475s and 1,000 of those 450s, whereas here, a good chunk of those items, right, went out at a different price at 425 because I updated my inventory records as I made the sale. So there is a difference for LIFO. Okay. Okay, good. Let's take a look at dollar value LIFO. Now, I don't know. I should stay off of that Facebook. Once you subscribe to that Facebook FAR group, then Facebook keeps alerting you that, you know, somebody posted something and then you see the post and you, I don't know about you, or hopefully you don't join that, but I sit there and I look at it and I'm like, be quiet, okay? And one of the things that I see a lot is people whining, crying about dollar value LIFO. No need. It is not hard, guys. It's kind of fun, okay? I think what happens is they don't pay attention to just the very basic thing that you need to calculate the price index, and then they feel bad, okay? Now, when they say when the price index is computed internally by the company, if it says that, that means you, CPA candidate, you will calculate it. So don't sit there and look anymore for the price index. If they tell you that it's internally calculated, that means they're saying you have to calculate the price index, okay? Now, calculating the price index, and I think this is where folks start to make the mistake. Ending inventory, it's calculated on total ending inventory, right? The word total ending inventory, current year cost versus total ending inventory at base year cost. And they're going to have to give you both of those so that you can calculate the price index. So when you look at this example, okay, flashcard that price index, but let's take a look at this example. And notice they give me base year, they give me current year. They have to give you that to calculate the index, okay? Then you come over and notice the total at base year is 45, The total at current year is 54. I think the mistake that people make, don't circle this, they try to focus on the layer that was added. No, it's total at the end of the year, total of the base total for the current. And when you do that, you get the correct price index at 65. Not 65, but 6/5. Then you sit there and you look at, and they have to give you this, what was the layer that was added this year at base year, multiply that by the index, and that brings the layer that you added this year to current, and you add that to your what? To your beginning inventory at your base. That gives you your dollar value LIFO. Okay, so the big mistake, I'm pretty sure, when I sit down and I talk to students about dollar value LIFO too, because they're having problems back in the day when I could sit down with somebody and explain this to them, you look, and the mistake that I would see students make is they would try to calculate the index here. No, you don't calculate the index here, it's on the total. Okay, so just to go into the second year, again, they have to give you the year end at base and at current dollar if they want you to calculate the index. You go ahead, and this is a little hard to see, they forgot I was like looking at this earlier, I'm like 800,000, where did that come from? It's 80,000, they left out a comma there. Okay, but it's what? The 80,000 divided by the 60,000 gives me 4/3. I pick up the layer always at base year, multiply it by the 4/3, and now that brings the layer to the current, and I add it. Okay. Even the dollies see how easy that is. Okay, so not tough at all. Okay, question? These are fun. Let's say you decide at some point after you get the vaccine and stuff that you're going to invite some friends over, and you're wondering, what should I do to entertain my guests? Have them work some of those dollar value LIFO questions. They'll love it. Okay. All right, good. Now you take a look and they say price index supplied. Well, if the price index is supplied, first of all, say thank you, CPA gods, because they just made this easier for you. You don't have to calculate the price index if they give you the price index. So that's beautiful. Okay. And so you just take a look at the fact pattern here. Then they have to give you base year cost. Okay. And then what? You will see that you have added 25,000 at base year cost, but now you need to turn that 25,000 into what? Current year. So since I added 25,000 at what? At base year cost, but I want to turn into current cost, and they gave me, thank you God, they gave me the price index. So I just multiply that by 1.10 that they gave me up here. And now I can sit here and just add what? Add that to the base year of 500,000. I add the current year layer. I got my dollar value LIFO. So if they give you the date of the index, that's even easier. Okay. Okay, so don't worry about those dollar value LIFO questions, guys. Don't get freaked out. I think if you sit there and you, practice using that formula properly, and you might make some mistakes a couple times, but once you kind of get some practice under your wings on that, there is no reason for dollar value LIFO to be hard for somebody. Okay. All right. Gross profit method. What happens here? Okay. Well, gross profit method, basically, if they tell you you have a gross profit of 20%, you can take 1 minus what? The 0.2, and you've got a cost complement, okay, of 80%. Now that is useful because then you can take your sales, multiply that by the cost complement, and now you've got your cost of goods sold. And if the question asked you something like, well, they don't know what the value of the ending inventory was, well, you could take your beginning inventory plus your purchases gives you your goods available for sale. Okay, and this is where even if they're using a perpetual method, it still may be useful to know that formula. Beginning inventory plus purchases equal goods available for sale. And you know that what? If you were to take your cost of goods sold off of that you just estimated using the gross profit method, then the inventory that got destroyed must be 40,000 because what? Goods available for sale minus ending inventory of 40,000 would have given you the cost of goods sold of 160, but you had the cost of goods sold, you had to figure out the ending inventory. Okay. Okay, firm purchase commitment. If a company is committed to purchase inventory at a certain price, and then the value of that inventory falls below that purchase price, you have a loss. Okay, so you take a look at this example. You have agreed to purchase inventory for 5 million, but the market has fallen. Now you say, well, if the market fell, then that guy should write it down, the guy who's selling it to me. No, remember we said that if you have a contract to sell the inventory at a certain price, you don't have to write down the loss there. Who writes down the loss? The person who has agreed to purchase it from you at that higher price. They take the loss, even though they haven't received delivery of the inventory yet. And so they would literally have to debit loss and credit a liability because they're sitting there and saying, hey, when I get that inventory over here, I'm gonna have to pay more than its market. But that happened, that loss occurred from my purchase commitment that I signed this period. So you have to estimate and take that loss immediately. Okay. Question? Okay, good. Let's look at a couple questions here. And what I'm going to do here is put the poll up, and I'm going to give you 3 minutes. You know what I'm going to do? I'm not going to give you any time. I'm going to go over it with you. And the reason I'm doing that, so what do I want to cancel the poll or something? Okay. The reason I'm going to go over it with you is these are a little bit of tougher questions. And I feel like, you'll just kind of sit there and struggle and you won't feel any better. Okay. And I want you to feel good about this stuff. So I'm going to go through this with you. Okay. This question 1. So let's just take a look. So we got this Bren company inventory at January 1st, year 3 was understated by 26,000 and its ending inventory was overstated by 52,000. What's the impact on the cost of goods sold? Now, when you look at a problem like this, they're trying to bait you into making the mistake of trying to simultaneously calculate the impact of these overstatements, understatements on cost of goods sold simultaneously. You are better off if you do them one at a time. For example, they tell me that the beginning inventory is what? Is understated by 26,000. That means it's 26,000 too little, isn't it? So I'm going to put a minus 26,000 there. Okay. Now, I don't care what the purchases were. Doesn't matter. Whatever the purchases were, when I add them to beginning inventory, it's 26,000 too small. That means my goods available for sale is 26,000 too small, isn't it? As you add purchases to beginning inventory is 26,000 too small. Goods available for sale is 26,000 too small. then I subtract my ending inventory to get my cost of goods sold, don't I? But I'm not going to do, everyone says, oh, wait a minute, they told us about ending inventory. Ignore it for now. Don't worry about the ending inventory situation right now. If my goods available for sale is 26,000 too small, then my cost of goods sold is 26,000 too small. Okay. Now I got to deal with what they told me about the ending inventory. Ending inventory was overstated by 52,000. Well, again, using my little, beginning inventory, post-purchases stuff, I don't care what the beginning inventory is. I don't care what the purchases are. That's purchases. I don't care what the goods available for sale are. What I know is that what? Ending inventory was overstated by 52,000. That means that I subtracted in my ending inventory a number that was 52,000 too big, right? It's 52,000 too big. So I subtracted too big of a number from my goods available for sale, meaning that my what? Cost of goods sold is 52,000 too little, right? Because I subtracted too big of a number for my ending inventory. So if you look at what? The understatement of cost of goods sold because of the beginning inventory problem and the understatement of cost of goods sold because of the ending inventory problem, I have what? I have an understatement, choice C, of 78,000. Question?
Professor, sorry, how did you get minus 52,000 in COGS? Could you please explain that again?
Yeah, if my cost, if my goods available for sale was 100,000, let's say, and my ending inventory correct balance was say 100,000, then my cost of goods sold would be zero, right? Right?
Yes, Professor.
Okay, well, if my goods available for sale is 100,000, but they tell me that my ending inventory is overstated by 52,000, that means that my incorrect amount that they told me for my cost of goods sold here is 152,000, right?
Right.
And if I subtract 152,000, a wrong number, from 100,000, that's telling me my cost of goods sold is a negative 52,000 when it's actually zero.
That's true.
Yeah.
Thank
Okay.
you. Thank you. Yeah.
Yeah. Okay, good. Let's try. I'm going to let you try question 2. It's a little tough. I'll give you 3 minutes. Don't be scared. I don't mean to scare you. Okay. Don't be frightened. But go ahead and try this question 2 here. Okay, give it a shot. Let's see what happens. It's a little hard, but I think you can do it. Okay, guys, don't try to rush me along by just choosing an answer and hoping that somehow that'll get me to move on. Okay, because I'm looking a minute 30 into the time. I don't feel enthused that you were able to answer it that fast. Take the time. I'm giving you the time. Take the time, see if you can do it. Ten seconds, guys. 3, 2, 1. Okay, go ahead and make your best choice. And let's take a look. And okay, not the percentage we're shooting for here in class, but by the same token, we're usually trying to get about 75. We got the reverse of 75. We got 57. Not bad for a question that's maybe this difficult. Okay, so let's go through it together. And that pain that you're feeling while you're trying to answer this question, okay, is the weakness leaving your body. You sit there and you struggle with this. It's the weakness leaving your brain, whatever, okay? You keep doing this and you keep struggling. All of a sudden, that pain is actually you getting stronger, okay? So let's just go ahead and let's take a look at this. But I can't get you there if you don't try these. I can't get you there if you don't sit there and struggle with these and try them. You got to do that part, okay? But let's just take a look. So I'm going to do perpetual first. Okay, they asked me perpetual, they asked me periodic. I'm going to do perpetual first because I'm thinking, well, look, all I've got to do is keep track of what's happening with this inventory down here. Set up myself a little T account, and I should be able to see what the inventory balance that they want at the end of the year is under perpetual, right? Because you keep track of your inventory after each purchase, after each sale. So they tell me, they just come right out and tell me that there were 2,000 items, $2,000 worth at $1 a piece of inventory at the beginning of the year. Then they tell me that they purchased what? They purchased $3 unit cost to 100. They purchased 3,600 more. Okay. Then they tell me that they sold 1,800. Now to get to the 1,800, since they're using what? Last in, first out, and we're using the perpetual method, I'm going to have to do what? I want to sell 1,800. Well, I first got to take these what? 1,200 at $3 each. That's 3,600. I know that's coming out using the perpetual method. And then I only have what? To make up for its 1,800, to make up the remaining 600 items. 600 items to bring me to the 1,800 that got sold is, I'm going to have to pick from these dollar ones. So 600 items times $1 equals, of course, $600. Okay. So I take out the 3,600, I take out the 600, and then I go ahead and I bring in these last ones here at 800 of them at $5. I bring in that last 4,000. And when I balance out my debits and credits, I get what the balance in here is 5,400. Okay, so within a fairly short period of time, I've narrowed this question down to either what? B or D by starting with perpetual. Okay, now I'm going to go with periodic. And when I see periodic, that's what? That's beginning inventory plus my purchases minus my, which is the answer here that they're looking for, right? That's my unknown that I have to figure out, is going to give me cost of goods sold. So I know that the beginning inventory is $2,000. I know that they had purchases, and they had purchases of what? Just kind of peaking at my what I just did a minute ago with the perpetual. I know that my purchases are going to be, what is that?
400.
What?
3,200 plus 22. Right, 800 plus 1,200.
Okay, my purchases were 36 and 4,000, right?
Yes.
Right?
I was giving units,
Purchases.
sorry.
Yeah, 36 and 4,000. No, that's okay. So 3,600, I'll write it in detail there. 3,600 plus what? Plus 4,000 are my purchases. So I kind of messed up my formula because I forgot to put what? Goods available for sale then is what? 9,600? Am I doing my math right?
Yes.
Yeah, goods available for sale is 9,600. Now I got to figure out, let me write it back in. The ending inventory here is the question mark. So there must be some way to figure out what my cost of goods sold is. Well, my cost of goods sold is going to be what? My cost of goods sold is calculated using LIFO by saying that I sold my 8,000, using last in first out, I should say 800, and I would have assumed I sold those first, right? At $5 each, last in first out. And so that's going to be what? That's going to be 4,000. And how many total units did I sell? 12. So I got 8 there. So I need what? 400 more. And those 400 more now are going to come out at what? Not 400 more. What do I need?
1,000.
1,000 more. Right here. I'm trying to get that 1,800, not that 12. That 1,000 more, and that 1,000 more are going to be at that next price, which is what?
$3.
$3.
$3.
Good. So I multiply that by $3. Good, guys. So that gives me 3,000. So my cost of goods sold, I know using LIFO is supposed to be what? 7,000. So then I got to do my little side calculation here. 9,600 was my goods available for sale. And if I ended up with a cost of goods sold of 7,000, that means that my ending inventory must have been what? must have been 2,600. And of course, right on the page break is 2,600, right? That's my ending inventory. Just trying to, won't let me write it right next to where I put ending inventory. 2,600. So the answer here is what? B? Which most of us got it right. What, 57% of us? Okay, that's a tougher question. You got to work with that a little bit. The more you practice with these, the more weightlifting you do, the stronger you get. This is not, jogging. This is not, well, let me just repeat this, by looking at these flashcards enough time till I got it. This is what I like to call weightlifting, and that you got to keep struggling with that and put that heavier and heavier weight on here till eventually you're good at this, and then you have the accuracy, and then we can build speed as we move into our final review, etc. Okay. Question? All right, I think we got a good point for a break here, so we'll come back. Let's make it 10 to 7, about 10 minutes. Okay, and we'll come back and move into our fixed asset discussion. Okay, guys, let's go ahead and jump back in. I want to, hopefully we can finish chapter 3 tonight. If not, definitely I'll make some good headway in it to allow you to knock out as many of the modules as possible tomorrow, or at least make the flashcards for as many of the modules as possible. Okay, so let's go ahead and turn our attention to property, plant, and equipment. Okay, now the terms property, plant, and equipment are really land, right? Buildings, and equipment is equipment, right? And what we're going to be taking a look at here first are what are the nature of costs that should be included in these elements of property, plant, and equipment, land, building, equipment. And it makes a big deal because what? Because some costs, like land costs, are not depreciated. And so it's going to be important that we carefully capture the costs that belong in these categories, because we have to ultimately figure out our depreciation. We'll look at that here tonight as well. Okay, how our different depreciation methods. So we come in, historical cost is what we should be carrying. Our property, plant, and equipment. What did we pay for it? Okay, it doesn't matter if it goes up in value, we leave it at its cost. Now we'll see that there could be impairment, and you could write it down from its cost, but we will not write it up above its historical cost, our property, plant, and equipment. Okay, now you come over and you take a look at the rule here for our cost model. Okay, and we have what cost model is basically whatever its historical cost was minus the accumulated depreciation minus impairment, and that's what we're going to do for US GAAP. Now again, IFRS is being de-emphasized, will be eliminated in July of this year of 2021, but we do have the idea of a revaluation model under IFRS, and IFRS does allow an entity to write its fixed assets up above the historical cost, and so we're going to have a little different approach than we have under US GAAP. Now what we do is we have the revaluation losses. And when a fixed asset loses value, it is reported on the income statement. Unless, and this again only under IFRS, we have been allowed to take a revaluation surplus previously, then that would go against that revaluation surplus included in other comprehensive income. Okay, so it would first go to the income statement unless there's been some gains in previous periods. that are included in other comprehensive income. Take that revaluation loss to the other comprehensive income until you used all those revaluation gains up, and then revaluation losses will go to the income statement. Now, if you have revaluation gain first goes to other comprehensive income unless there have been revaluation losses that were previously recognized in the income statement. If that's the case, then the revaluation gain first goes to the income statement, and any remaining gain over and above the losses you've previously recognized in the income statement will go to other comprehensive income. Okay. Now, when we do these calculations, we have to do the calculation by class of fixed assets. So you would do it separately for property, separately for plant, separately for equipment. Okay, again, this is IFRS only. Okay, so you come over and you can take a look. We have these three classes: land, building, equipment, because again, you have to do this by class. And notice for the land, we have what? We have an increase in value. That increase is going to go to what? Going to go to other comprehensive income. Here for the building, we have what? We have a loss. That loss will be going to the income statement. And then for the equipment, what do we have? A increase. That increase will go to not OIC, OCI, John, other comprehensive income. Okay, so that's the way you look at it. That's IFRS only. You can write them up. If you're writing them up, it first goes to OCI. If you're writing it down, it first goes to the income statement, and so on. Okay, all right, good. Property is land. Okay, now they give us different things that include the cost of land, all of these different things. Okay, clearing of bushes and trees, anything cost that you incur to get the land nice and flat so you can begin building on it is part of the cost of the land. Once you start to dig a hole to build the foundation, you start to excavate for that building, that becomes part of the cost of the building. Okay, so they continue on with some of these, but what I really want you to do, grading of mountaintops, getting it nice and flat. Okay, all these different things, but what I want you to do is just flashcard these last couple, because these don't exactly leap to mind. So what happens? You have to pay some cost to tear down an old building. That's part of the cost of the land, because you can't start digging for the foundation for the building until you remove that old building. Then what? Then you sell some of that metal and whatever's left, you sell it as scrap. Well, that would be coming off the cost of the land because you were able to recoup some of those costs. Okay, so flashcard those last two. Now, land improvements are basically like a building. Okay, they're depreciable, but we don't call them building yet because they're not building. They're fences, water systems, sidewalks, etc. Okay, landscaping. Landscaping is part of the cost of the land improvement. Okay, so you'd have to sit there and figure out, well, what's the depreciation on my landscaping? All of that. Okay. Now we'll talk about capitalization of interest cost here in a little while, but now we start getting into the cost of the plant. Purchase price of the plant. Repairs neglected by the previous owner. Let's say there's a bunch of dry rot that the previous owner didn't keep up with or didn't paint or whatever they should have done. Well, that would be, if you're going to have to catch all that up, that is part of the cost of that building. Okay, alteration, architect fees. Again, we'll talk about interest costs here in a little while. Okay, so notice, guys, I only had you flashcard a couple things here because I think the real flashcard is more of a visualization right here. Okay, the cost of the land is anything you have to do to get the land nice and flat so you can begin building on it. Once you start excavating for the building, putting stuff on top of the land like fences and landscaping, that's part of land improvements or building. Okay. Okay, good. Now, they tell us here that if you have a basket purchase, that you have to allocate those to the respective items. So let's say, and I'm just going to have you write in an example here. Company purchases building for, not building, land and building. Company purchases land plus building. Okay, they purchase land with a building on it for $500,000. Now we want to figure out how much of that is land, how much of that is building, because we depreciate the building, not the land, right? So they tell us to go by the ratio of the appraised values. So we call in an appraiser, and the land appraises, however you spell appraises, at 100,000. The building appraises at 300,000. Now, sometimes students will say, well, how could that be? You paid 500,000, yet the two pieces separately appraised for only 400,000, you got took. Well, no, because they appraised that land as though that particular building were not on it, and they appraised that building as though it were not on that particular piece of land. But you put those two things together, now they have a value of 500,000, right? Okay, someone's willing to pay 500,000 for a building that's perfect for a restaurant that's sitting in a restaurant district, right? Okay, but if you appraise them separately, they don't come out to that same amount, whatever. Okay, so there'll be difference between the appraised values and what you pay. So now I come up with the ratio for the land. I come up with 100,000 divided by what? The total 400,000 times the $500,000 purchase price. That means that the land is equal to what? 125,000. Then I do the building. Building is 300,000 of that 400,000, or what? 75% times the 500,000 gives me 375. Am I doing my math right? Okay, so you would need to do that. That's not that difficult. You see a couple questions like that in your homework and stuff, easy questions. You'll have fun with those. Okay, now equipment is similar to inventory. Remember we said with inventory, any cost that you have to pay to get the inventory to your business so you can sell it, whatever is part of the cost of the inventory. So what? Transportation cost in is part of the inventory cost. Equipment, same kind of thing. Okay, so your invoice price, cash discounts, freight in, installation charges. You have to install it somehow. That's part of that equipment. Excise tax. I had a former student who emailed me one time and said, I'm in a big argument over here at work. They want to expense the costs on computers if they charge you for disposal of the computer. They charge you that fee for disposal of the computer. You know, at the end, like they'll charge you $25 or something. That's capitalized. Any cost that you have to pay to acquire an asset is part of the cost of that asset. And again, we're going to get to, I promise, construction period interest here in a second. Okay, so you basically will capitalize a lot of these costs down here, and then expense is probably going to be more the exception than the rule. Okay, so what should we capitalize? We should capitalize additions. You add to the machinery somehow, then you're going to debit the asset, credit the cash accounts payable, whatever. If you have improvements and replacements, there's a couple of different things that you're going to do here. Okay, and if you are basically improving the asset, okay, the improvement should be capitalized. Okay, if you're improving an asset, you should capitalize that. Okay, now in an improvement or a replacement, if the carrying value of the old asset is known, remove it, recognize any gain or loss, and then record. In that case, I guess it's not a improvement, it's replacement, and then capitalize the cost of that improvement replacement. Now, you sit there and you say, well, what do you mean if the carrying value of the old asset is known? I mean, is this poor accounting or something? Because they tell you if the carrying value of the old asset is unknown, then if the asset life is extended, then debit the asset account. If the useful life of the asset, usefulness of the asset is extended, debit the asset account. If the life is increased, debit accumulated depreciation. Okay. Now you sit here and you say, well, how would the carrying value of the old asset be unknown? Well, let's say you buy a building, and when you buy the building, there's a roof on it. You pay, $500,000 for the building. It has a roof on it. Then 5 years later, you have to replace the roof. What's the carrying value of the roof? I don't know. The carrying value of the roof was there when the roof was on the building when I bought it, and I paid $500,000. Now I got to replace the roof. You pay $50,000 to replace the roof. I would argue that would probably do what? That would probably extend the life of the building. So you would debit accumulated depreciation and credit cash for $50,000 in that example, because you extended the life of the building by replacing the roof, right? Okay. If you were, say, overhauling an engine in a vehicle, then what? Well, maybe now you're increasing the usefulness, right? Because what? You can sit there and take it on longer delivery schedules than you would otherwise. So then you would debit the asset and credit the cash, whatever you paid for that. Okay. So if the carrying value of the old asset is known, remove it, recognize gain or loss, capitalize the cost of the improvement. If the carrying value of the old asset is not known, then go ahead and do this. If you increase the life, if you increase the usefulness of the asset, then go ahead and debit the asset account, which is what we say right here. Question? Okay, good. Then you come over, and if you have repairs and they are ordinary, you should expense them. So that's why I say you looked at this thing and we said what? Expense versus capitalize. And then the only thing that's an expense is an ordinary repair. If it's an extraordinary repair, again, like you overhauled the entire engine, you replace the engine in a vehicle as opposed to, say, changing the oil, that should be what? That should be capitalized. Or oil is probably not the best example. Let's say you have to change the tires. Sometimes I'll have students will ask me, so if I change the tires in a car, should I capitalize that? This is Accounting 100 students. No, that's an expense. That's ordinary wear and tear. Just expense that, right? But if you're sitting there and you replace the engine in a vehicle, then that's the kind of thing that should be capitalized, because it would be seen as an extraordinary repair. Question? Okay. All right. You don't need that summary chart. All right. Let's talk about capitalization of interest and what happens here. Well, let's say I'm going to borrow money, and I'm going to borrow money for the construction of an asset, and I'm either going to sell that asset after I'm done constructing it, or I'm going to use it for my own purposes in my business, right? So I'm building a building, I'm going to use it in my business. I have to borrow money. They allow me to capitalize any interest, not any interest costs, under special rules, certain interest costs associated with that borrowing. Let's say I'm building you a cruise ship. You're Royal Caribbean, I'm a shipbuilder. Well, now I'm going to be making that inventory specifically for you. I'm going to be making that item specifically for you. I am able to capitalize that. Okay. So I go ahead and I capitalize things that are part of discrete projects. Okay, I do not capitalize interest for routinely manufactured things, like if I'm borrowing money to construct inventory for pens, I don't make a pen specific to your request, right? So it has to be things that I'm making that is part of a discrete project, such as real estate projects. A ship or something like that would be an example. Okay, now when I am figuring out the interest to capitalize, I have to use the weighted average of accumulated expenditures to calculate that. Now, that could be given in the problem, or you calculate. Now, unfortunately, the book doesn't give us an example in the text here anyway. You'll see it in problems, but right here, they don't give us an example of how to calculate this weighted average of accumulated expenditures, but it's not that hard, okay? So let's say, and you can just sort of write this in, company, let me put the date in here, on 1/1/2021, company spends $1 million on construction project. Okay. And then on 9/1/2021 spends 500,000 more. Okay, let's go ahead and see if we can calculate the weighted average of accumulated expenditures. That's what that is, weighted average accumulated expenditure. Okay, so what we would do is we would take the million, and the million was the amount that they had spent, and that was the amount for what? For 8 months? All of January, all of February, all of March, all of April. That's what? 8/12 of the year. You take that million times 8/12 and you get 666,667. Okay. Then what? Then they spent 500,000 more. So you could look at that and say, well, then there was 1,500,000, and that was outstanding for what? The back end of the year, September, October, November, December, for 4/12 of the year. And that's going to give me 500,000. You add that 666,667 plus the 500,000, you come to 1,166,667 would be the weighted average of accumulated expenditure here. Okay, now if they give you the weighted average of accumulated expenditure, then you're happy. You don't have to worry about anything at that point. You just take that number. If they give it to you the way we saw here, then unfortunately I'm going to have to sit here and unfortunately, it's fun, right? This is why we became accountants, so we can do this kind of stuff. Then you're going to have to calculate it. Okay, now once I have that weighted average of accumulated expenditure, then I have to apply an interest rate to that. Now, and we say qualifying asset meaning it's not routinely manufactured inventory. It's something I'm making to specifics for my own use or for somebody else's use. But when they say an interest rate, then you say to yourself, well, what interest rate should I use? And you should use the interest on the specific borrowing for the construction. Okay, well, that's given. So you'll have what? You'll have weighted average of accumulated expenditure. They'll give you, you may have to calculate that, or that'll be given. Then you'll have to what? You will have to calculate, we'll have to apply that interest rate that's given to the weighted average of accumulated expenditure. And whatever that comes out to be, that is the first step in figuring out how much interest. Now, in the event that the weighted average of accumulated expenditure exceeds the specific borrowing, then interest needs to be accumulated on the excess. And the way you do that is you basically take the weighted average interest for all other borrowings of the company and apply that to the amount of borrowing that exceeds the weighted average of accumulated expenditures. Okay. And I'm sorry, I said that backwards. If the weighted average of accumulated expenditure exceeds a specific borrowing, that difference, you're going to have to apply an average interest rate to all other borrowings, and you apply that to the excess. Okay. You cannot exceed the actual interest cost. You are capped at your actual interest cost. That's the most you can capitalize. Okay. Now, it's kind of hard to follow those flashcards as I'm going through and asking you for the flashcards, kind of follow the rules a little bit. But when you look at this example, you're going to see that it's not that difficult. Okay, so now we're going to apply those rules to this fact pattern. You'll see that it's not that difficult, and I think partially the way I explained it wasn't my greatest moment either. So let's just look at this example, and then you'll see that it's pretty straightforward. So on July 1st, Convisor Kitchen Inc. signed a fixed price contract to have a new kitchen built for $1 million. On the same day, they borrowed $500,000 to finance construction. The loan is payable $100,000 payments plus interest, 11%. Do I need the interest rate on the specific borrowing? Yes. Convisor plan to finance the balance of the construction cost using the company's existing debt with a weighted average of 9%. Okay, if I have weighted average of accumulated expenditure that exceeds that 500,000 specific new borrowing, I'm going to have to apply that other rate. Okay, and then they tell us that their interest cost, where actual interest cost was 150,000. And thank you, God, I did not have to calculate the weighted average of accumulated expenditure for this question, although I could. They could make me calculate it sort of the way I showed you. Here they gave it to me. Okay, so what happens? Well, the specific borrowing was 500,000. So I can only use that 11% on that part of the weighted average of accumulated expenditure. For the extra 100,000, right? 600 minus 5, there's 6 left. I have to pick up what? I have to pick up that second interest rate, that 9%. These are the amounts now that I will capitalize. I won't expense that. I will capitalize that as part of the cost of whatever this thing is, the soup kitchen, this building, whatever. So that gives me what? Total capitalized interest of 64,000. And since I didn't exceed that 150 of actual interest, ding, I am good to go ahead and capitalize that whole 64,000. I'm capped at that 155. But here, since I'm well under the 155, I can take the entire 64,000. Did I say 155? Under that 150. Okay. Now, in order to capitalize interest, guys, go ahead and flashcard this. And notice when you get a rules heavy area, that's where you start flashcarding. I mean, this is one of the big complaints about US GAAP is it's rules based. There's a lot of rules here, right? So what do we got to do? We got to flashcard it. Okay, so expenditures are being made, activities are necessary, interest cost is being incurred. Continue that flashcard onto the next page. Continues, stops during intentional delays, but continues during ordinary delays. Intentional delay, I started building houses and the housing market did this, so I'm going to stop building the houses for a while. Okay, we'll stop accruing interest for that capitalizing, excuse me, interest for that period of time, because that's an intentional delay. Unintentional, I can't continue construction because it's been raining for 2 weeks, for a month, for 40 days and 40 nights. I don't care how long. If that's a ordinary delay in construction, of course, 40 days and 40 nights would not be ordinary, but customary. Why you can't construct during rainy season, whatever, then I could capitalize interest during that time. Okay. Okay, good. I'm not going to go through all that. Okay, guys, let's go ahead and let's try a couple of these. I think you'll see that these ones about what to capitalize and what not to are not that hard. So I'm going to let you try this one. I'm going to give you 1.5 minutes to do this one. Okay, good. I gave you a little more than 1.5 minutes with this one. So go ahead and let's make our choices and take a look. And okay, most of us got this one right. Okay, good chunk of us, 80%. Okay, so 79%, whatever, right? So let's just go ahead and get rid of that for a second. The answer here is A, but let's just take a quick look at this one. Now, of course, you can't get to the answer without picking up that 400,000. So they knew that was pretty easy. We have to do what? We have to add the 50,000 demolition costs, right? Legal fees. Yeah, got to pick that up. Legal fees to purchase are part of the cost. Title guarantee insurance. Yep, better pick that up. That's 12,000. Then what? Proceeds from the sale of the salvage material. Well, that, yes, we consider it, but we do what? We subtract that, right? So maybe that's how some of us got a different number. You didn't subtract that. That gives us what? The 464? Any cost that you incur to secure that building is part of the cost of the building. And no one is going to give you title to that building without the title guarantee insurance. So you're going to have to pay that. That's part of it, that 12,000. That might have messed some of you up. Okay. Okay, good. Let's take a look at this next one. Okay, guys, let's go ahead and choose your best answer and take a look at this one. And yeah, that's good work. Okay, that's 77%. That's good. This is not too tough of a question, but kind of multi-layered. And so sometimes it's hard to figure this out. So did I show you the results? Most of us got this one right. Okay. All right. So let's go ahead and let's take a look at this one. Okay. Now, this one, we had to calculate the weighted average of accumulated expenditures, right? And so they told me that they had spent $1 million on January 2nd. And then by December 31st, the last day of the year, they spent $1 million more. Okay. So what do? Well, 1 million times what? Times 12/12ths of the year. That was outstanding for the entire year, right? And so that's going to be, of course, 1 million. Even I can do that one in my head. And then what? They spent another $1 million. So if they spent another $1 million, then there was 2 million. But 2 million was outstanding for what percentage of the year? 0/12ths. Okay. So that's 0. Okay. So the weighted average of accumulated expenditure is what? Is $1 million, because they didn't spend that till the last day of the year. Okay, so that last million isn't even really part of this calculation here. Okay, so I've got the million as my weighted average of accumulated expenditure. They give me the interest rate. I apply that interest rate. They got to give me that. Potentially, I'm going to capitalize 80,000. Now, you always got to make sure, it was pretty obvious in this problem, but you always got to make sure that you have not capitalized more than your actual interest. So they borrowed what? 3 at this 8%. So 3 million times 80% would have been what? 240,000 in interest. And what? This 80,000 is well below that. So yeah, we're good. We can take that 80,000. Question? Okay, good. All right, let's come over. Let's talk about depreciation. Depreciation is pretty easy. May you get 52 depreciation questions on your exam. You will not. Okay, the examiners, as I said in our introduction, this is usually about 5 points. The examiners know that they're going to have a hard time tricking you on depreciation, right? We know that we're going to have whatever we had originally paid for that asset minus any salvage value. And then we will generally, at least for straight line, divide that by the estimated useful life. Either way, useful life will be included in the calculations, and salvage value will be considered in the calculations. Okay, so let's go ahead and we'll start to talk about some of the different methods here in a minute. But let's talk about component or composite depreciation, okay, or group depreciation right here. I want to talk about group depreciation right here, okay? Now, when you have asset retirement, okay, then when the asset is retired, the gain or loss of results is absorbed by the accumulated depreciation account. So there'll be, you can add that to the flashcard, no gain or loss. No gain or loss, okay? So let's just go ahead and they tell us, we can even include that on the flashcard if you want. The accumulated depreciation account is debited for the difference between the original cost and the cash received, okay? Include that on the flashcard, but let's just look at this example. So we've got these different assets that are being depreciated as a group. Now we take the total of the cost, we take the total of the salvage value. That gives me a depreciable cost of 720,000. Now, if I depreciated them, each one of them separately, okay, and then I total that, that gives me the total annual depreciation for this group. I take that and what? I now have 720,000 divided by 45,000. They're depreciating this asset over a 16-year period on average, okay? Now, the big deal is right here, okay? And notice I'm going to put again, no gain or loss. That's the point of this example, okay? Because they sell it for 260 cash, so they have to debit cash. It's asset A. They do what? They take it off at its total cost, and generally I don't like to call things out as a plug, but this is a true plug. This is the real thing. If there's ever a plug in accounting, this is it. You simply debit the accumulated depreciation for the difference between the cash and what you had originally paid for that asset. I know it said debit or credit the accumulated depreciation. It's highly unlikely that you're going to be able to sell an asset after some time for more than you had paid for it some time back. I mean, assets just generally don't work that way unless it turns out there was some vintage something or another. So generally, it'll be a debit to accumulated depreciation. There's no gain, or in this case, there's no loss calculated. You debit accumulated depreciation. Okay, question? Okay, good. That's the takeaway. No gain or loss. That's what's on the flashcard. Okay. Now let's come over and look at depreciation methods. Straight line, easiest thing in the world. Probably the first thing you learned in accounting, or where you really started falling in love with accounting, right? Is what? The original cost minus the salvage value divided by the estimated useful life gives you your annual depreciation. Okay. The only thing is look to see when asset is placed in use. What the examiners love to do is they know this is easy. So they say the asset was purchased on October 31st. They'll say something like that. And they say that in the very beginning of the question. And then they put a bunch of stuff you don't need in there. And then they give you the information you need to calculate the depreciation. Meanwhile, back at the ranch, you forgot to look to see when the asset was put into use. You calculate the full year's worth of depreciation. The problem puts as choice A, the first choice, they put the full year. Meanwhile, down there in D, D is the partial year depreciation, and that would be what? November, December. They like to put it on the last day of the month to get you to mess up and count October in that example, right? So it'd be used for 2/12 of the month. So you'd only take 2/12 of the year. So you'd only take 2/12 of the depreciation in that case. That's how they make straight line questions worthy of you potentially missing them by putting the asset into use, after the start of the year at some point. Okay. Okay, good. Sum of years digits. Again, nothing that difficult. Whoever thought of the sum of years digits method of depreciation had way too much time on their hands, okay? Because if you have an asset that, say, has a 5-year life, okay, what would you do? Well, you would take 5, you would add up the sum of the 5 years, year 1 plus year 2 plus year 3, 4, 5, that's 15. And in year 1, you take 5/15. In year 2, you take what? 4/15. In year 3, you take 3/15. In year 4, you take 2/15. And then in year 5, okay, you would take 1/15, right? And if you add up the numerators, hey, by that last year, you've taken 15/15, right? Whoever thought of this should have found a hobby, okay? But they figured this whole thing out, okay? Now, what happens? If you sit here and you add up the years, and by the way, notice we're taking more depreciation in the early years and less depreciation in the later years, right? Okay, so it's a way of sort of using a method where assets tend to depreciate faster at the beginning and more slowly at the end, right? As you don't use them as much because they're getting old or whatever, right? Okay, so that's what it's trying to approximate here, okay? Now, what happens? I don't want you on the exam with an asset that has a 50-year life and you're stuck there going 1 + 2 + 3 + 4 + 47. Did I say 46? Let me start over. Okay, so you need to memorize this right here, not this. You need to memorize this right here. Okay, you need to put that on a flashcard, and it's a way of calculating the life. If they give you some big numbers, it's N50, let's say, if it was a 50-year life, times 50 + 1 divided by 2 would give you the sum of the years digits of a 50-year life. Normally, the exam doesn't go much over 5 years, whatever. So you should be okay, but have that formula just in case. Okay. Now, what happens? The numerator here, I'm not going to show, I don't like the way they do that. Don't look at that. The numerator here is going to be the same as it was for straight line, which is the cost minus a salvage value. And if it was a 4-year life, right? 1, 2, 3, 4, 1 + 2 + 3 + 4 = 10. Or you could use the formula. That gives me the denominator. And then the numerator, year 1, take 4/10, and so on. Okay. Now, let's say the question asks you carrying value of asset at end of year 2. What's your answer? Carrying value of the asset at the end of year 2.
3,000.
Good. Thank you for making that very easy mistake. Okay, and that was why I asked it. When I say easy mistake to make, right? Because it's what? It's 11,000, and yeah, the depreciation after those 2 years, as you properly figured out, is 7,000. So the carrying value is what? 4,000, right? So be careful with that. That's an easy mistake to make. I got to stop talking about that Facebook thing. I see this on Facebook. I don't understand. How could it what is Becker doing? How could it possibly be 4,000? You know, it should be 3,000. And they forgot and they subtracted it from the depreciable base, not from the original cost, which is how we're supposed to report our book value of our assets. Okay. All right, good. Okay, question? All right, good work. Now, you could also use units of production. Now, units of production is probably the most accurate way to calculate depreciation. Meanwhile, most companies don't use it because what's going to happen? You're still going to have cost minus salvage value. That's the same as straight line or sum of years digits. But now, instead of dividing it by the years, whatever, like you would for straight line, you're going to divide it by the estimated number of hours you think you'll use this machine or the number of units it will produce. And that will give you a rate per unit or hour. And then once you have that rate per unit or hour, you will go ahead and multiply that by the actual number of hours you use that equipment and that, or the number of units produced. And that makes your depreciation expense. So if the equipment sits there and never gets used, no depreciation. If the equipment is used a lot, more depreciation. So this is probably the more accurate way to calculate your depreciation. The problem is that now I have to track the units or hours that this machine has been used or the units it produced. I've given myself an extra record keeping. So companies generally don't like to do this. And so they stick with straight line, or we'll see in a minute, double declining balance or something, because you don't have to track the actual use of this equipment. Okay. Okay, good. Now we talk about declining balance depreciation. Okay. And declining balance depreciation, the most common is double declining balance, but we don't have to use double. We could use 1.5 declining balance, triple declining balance, whatever. But commonly we ask for double. Okay. And when we do double, it's going to be double the straight line. Now, very important. When you calculate the depreciation to double declining balance, you don't use salvage value in the calculation. However, you got to kind of write the salvage value off to the side, and you are not allowed to depreciate below the salvage value. So you don't use it in the calculations, but you're considering it in that you won't depreciate below salvage value. Okay, so make sure you flashcard that. And flashcard that for double declining balance, for example, be double the straight line. Triple declining balance would be triple the straight line. 1.5 declining balance would be your 150%. Declining balance would be 1.5 the straight line, and so on. Okay. Okay, good. So let's go ahead and let's take a look at this example. And we have this equipment that has a $10,000 cost, $2,000 salvage value. It has a 10-year life, which means what? 1 divided by 10 equals 10%. And if I double that, that's what? 20%, right? Okay. Okay, good. So what happens? Notice I take the 10,000 in year one, the original cost, multiply it by 20%. That gives me 2,000 of depreciation for that first year. Now, I don't use the salvage value, but I subtract my depreciation from the 10,000 from year one, and I've got what? 8,000 left. I multiply that by 20%. That gives me what? 1,600 for the next year. Okay, then what? I take that 1,600 minus the 8,000. Now I'm down to 64, and so on. I'm not going to go through the whole table, right? I think you understand how this is working. Now, be careful though. If you were to come down to this 2,098, and if you were to take the 2,098, and if you were to multiply that by what? 20%, okay, you would get depreciation there of what?
$419.6.
419. Thank you. Thank you. And if you took 419 of depreciation, what would happen? That would now bring this book value, 2,098 minus 419, it would bring it down what? Below the 2,000. So notice they only took what? They only took 98 so that they what? Did not depreciate below the 2,000 salvage value. So even though they didn't use the salvage value in the calculation, they still kept their eye on it and considered it. So by the time they got down to this last year here, they only took $98 so that they would stop at the 2,000. So don't do this. Okay. Okay, good. Again, be careful. For all of these methods, if you put the asset into use after the start of the year, only take a partial year depreciation. Don't make that mistake. Don't make the mistake of taking a full year. Okay, good.
Quick question. This is probably a basic question. It's been a while since I've taken an accounting class, but what if it was placed into use in the middle of a month, like July 15th?
They don't do that on the exam. I don't think they'll do that. You know, they may, if they do, they may tell you something like the asset. I guess what they could do, if they do that, let's just put it that way. I don't see it that much, but if they did do that, then they could tell you that they take a full month depreciation in the month of purchase, or they don't take any depreciation in the year that in the month that they dispose of it. So sometimes you have to follow what they're telling you the accounting policy of the company is. Or what they could do is they'll give you the life, and if you wanted to try to get the answer with a half a month in there, then you'd have to figure out the monthly depreciation. So if it was a 3-year, you divide it by 360,000, and then if it was, you know, in use, say 7.5 months, because they put it in halfway, multiply that by 7.5.
Okay, thank you.
Yeah. The reality is my prediction is they're not going to do that. But if you do see that in problems, you'll kind of learn from the problems, some of those nuances, and you'll be fine with them. It's not like this will be something that jumps up out of the blue on you at the exam.
Okay, thank you.
Mm-hmm. Okay, good. Let's talk about depletion. Okay, that other stuff up there, guys, it's just a little bit annoying. Difference between the book value and what you sell the asset for cash is the gain or loss. Okay, cash is more than the book value gain. Cash is less than the book value loss. Okay, because they go a little overboard there with some of that. That's all that's going on there. Let's talk about depletion. Okay, so what's happening now? Now I'm sitting here and I'm paying an amount for an asset, not for what I can put on top of that piece. I'm buying a piece of land, but I'm not paying for what I can put on top of the land. It's what I can take out of the land. Can I take some coal out of there? Can I take some mineral out of there or something? Okay. And so you come over and you take a look, and I just want to go over to, yeah, am I on the next page? Yeah, over to the next page here, 6.32, okay? And let's first figure out the depletion base, okay? So the depletion base and flashcard base is whatever I pay for the property, plus any development costs for the extraction. What happens? I buy a piece of land because there's coal down there, but I have to get the people down there to pull the coal out. Sometimes they get stuck down there, right? And then they have the whole big thing about, there's this thing in, was it Argentina or Colombia or something like that? These poor guys got stuck down there, and they're having trouble getting them out. And then some trouble started because when they started getting the guys out, both the wife and the girlfriend was waiting for them to see if they would get out, and they didn't know about each other. And I think some of those guys said, "Can I go back in, please?" Okay, so they have to have a way to get down there, and so that's part of the cost. Plus any estimated restoration costs. Look, you're not supposed to just leave a hole in the ground. You're supposed to fix it up. At the end, you're supposed to put a park on top of it or whatever, right? Or you fix it up so it'll be appropriate for foundation for a condo, and then you sell it to that condo dealer. Well, whatever you can, for that condo developer, whatever you can sell it for, that comes off of that depletion base. Okay, so you have that depletion base. Then you have some engineers tell you, how much can you remove? You can remove 4 million tons of coal from this thing, whatever it is. That gives you your depletion rate, okay? Now what happens? Once you have your depletion rate, okay, then you can go ahead and recognize your depletion by simply multiplying by the number of units extracted to figure out what your depletion is, okay? So let's just look at this one. Okay, you got this Happy Mine Corporation purchased minerals for 3.4 million with removable estimated ore of 4 million tons. The property has an estimated salvage value of 200,000 after the ore has been extracted. The company incurred 800,000 in development costs preparing the mine for production. During year one, 400,000 tons were removed and 375,000 tons were sold. Okay. So what happens? First, we got to pick up the things that need to be included in the depletion base, the cost, the development cost. Actually, the cost is, the total is 4 million. The cost is right here. That's the 4 million. Development cost was the 800,000. I guess they're saying restoration is 0. If the federal government was doing its job, there should be a number there. The federal government Office of Surface Mining is supposed to enforce companies' cleanup of this stuff, and they don't do a real good job of it. And I've been mentioning this in my lectures, and then all of a sudden I noticed my LinkedIn profile was looked at by somebody in the mining business. So now I'm thinking, you know, they're seeing my stuff on YouTube and they're following me. Okay, so maybe I shouldn't mention that anymore. But they're supposed to restore it, but the federal government does a really poor job of enforcing that restoration. I know because I was on an assignment where we criticized them for that when I worked for the federal government, when I worked for the GAO. And then any residual value is subtracted. So that's where that 4 million came from. You divide it by the 4 million tons, that gives you $1 per ton. And your depletion for the period is going to be 400,000. The cost of goods sold, though, is what? Is going to be 375,000 because you only sold 375,000. So on the balance sheet, we would have inventory left of what? 25,000. Question? Okay. Good. Let's go ahead then and let's take a look at, and they give you a, I guess this could be okay. I have you making a flashcard, but you could use a mnemonic reel, I guess, if you wanted to, for the elements of the depletion base. Okay. All right, good. Let's take a look at these couple questions. And I'm going to put up the poll. And I'll give you a couple minutes for this first one. Okay, guys, let's go ahead and wrap up this one. Okay, so I'm going to go ahead and end the poll. And okay, about 73% of us got this one right. I would think this question would be a little easier so that we should get a larger percentage, but I know it's getting late and we're probably getting a little tired. So let's just go ahead and let's just take a look at this one together. Okay, so I purchased equipment for 100,000. Okay, and they tell me that it has a 10-year useful life. Now, if it has a 10-year useful life, that means I take what? 10% a year using straight line, but they tell me that they're using 200%, okay, which is what? Double declining balance. So using double declining balance, I'm going to be taking 20% a year. They bought the equipment January 1st, year one. They give me the salvage value, and look, I can tell you just by looking at the call to question. I don't need that because it's asking me for my depreciation in year 2. And there's no way that I'm going to be down to where I have to worry about the salvage value after 2 years. So I take that 100,000 times what? Times 0.2 means I would take 20,000, but that's what? That's year 1. My method here for double declining balance, you take the year 1 depreciation, subtract it off. Again, I don't worry about the salvage value off the purchase price. That's what? 80,000. That's what it starts for year 2. That becomes my depreciable base for year 2. Double declining balance. See how the balance is declining each year? And I multiply that then again by what? By 0.2. That gives me what? 16,000 for year 2. Choice B, which most of us got. Question? Okay, good. Let's see. What time do we have? Yeah, okay. I'll give you 2 minutes to work this one. Then we'll go through it together, and then we're going to call it a night. Okay, but let's go ahead and let's do this last one together. You do it, then I'll help you. Okay, guys, that's about 2 minutes. So go ahead and take your best choice. Okay. The votes are coming in. Is it going to be Biden or is it going to be Trump? No. Okay. The votes, I feel like it's election night. Okay. All right. So let's just go ahead and let's take a look. 65%. Okay. So most of you got it right. The choice here is B. And I know it's getting late and I'm rushing you a little bit. And I want to get this done for tonight because I know you probably got, got to get to other matters for this evening. So, let's just take a look. The right answer is B, but let's just look at this one together and then we'll get out of here. Okay. So what happens? They purchase a mineral mine for $2,640,000. Okay. Well, that's the kind of number that's pretty easy. I know I got to pick that up because that's what they paid for it, right? Removable ore is 1.2 million tons. I'm going to write that over here for now because I know I got to pick that number up. Worse will be required by law. Do your job, Office of Surface Mining, okay, to restore the land to its original condition at an estimated cost of $180,000. That's how it's supposed to work, but they don't do the best job at that. Vorst believes that it would be able to sell the property afterward for what? 300,000. So I got to take that off. During the year, Vorst incurred 360,000 of development costs. Got to add that. During the year, Vorst incurred 360,000 of development costs, preparing the mine for production, and removed 60,000 tons of ore. Okay. In its year-end income statement, what amount should Vorst report as depletion? Okay. Oh, they removed and what? Sold 60,000 tons. So this question's being a little cute in how they're asking you what the cost of goods sold should be on this, because it's reported on the income statement. Sometimes I see questions and I find it annoying that ask you what is the depletion expense. Then you should go by the amount that they sold in calculating that. They shouldn't do that. They really should either word it like this or just straight out tell you they want cost of goods sold. If they call it expense, you would do it the same way, but really most depletion mining type businesses would list it as a cost of sales and show a gross profit by subtracting it off the sales price. And you would calculate that by taking whatever our price per unit is here and multiplying it by the 60,000 units sold. So when I add everything up here, I get what? 2,880,000. Okay. I divide that by what? The 1,200,000. That gives me now 240 per, what is it, per ton? And so since they're asking me for the income statement and I sold 60,000 units, 2.4 times the 60,000, gonna give me what you guys got as the correct answer, 144,000. What would happen if they told me that they sold, they removed 60,000 units, but they only sold 20,000? Then what? Then it's going to be, and they wanted the amount reported on the income statement. Then they would have what? 20,000 times 240. What's that? 480,000 or something stupid like that? No, 48. What is that? 20,000. What is it?
48.
Huh? 48,000? Is that right? If I do my math right, is what would go to the income statement then. Okay. No, what is it? Is that right? 20,000 times 240. Yeah, 48,000. Okay. Okay, good. Question? All right, good. We're going to stop there. And the bad news is we were supposed to be starting chapter 4 on Thursday. We're still stuck in chapter 3. The good news is that it's probably not a good idea to make us go through non-monetary transactions here at the end of the evening when we're probably tired. And so I think we'll still be on track to get to where we wanted to in chapter 4 next time. Okay. All right. Good, guys. Any questions? No, we're running a little late. Okay, good. Well, have a good evening. I will see you on Thursday. You should be able to get all the way through module 5 now. Okay. And I'll see you on Thursday.
Thank you.
Thank you.
Have a good night.
Thank you.
Good night.